the Federal Reserve's rate cut decision, what it means for your money. Today, the Federal Reserve is expected to announce a decision to cut interest rates. This move, anticipated by many economists, is aimed at stimulating economic growth and managing inflation. But what does this mean for you and your finances? In this script, we'll explore the implications of the Fed's rate cut on various aspects of your financial life, from loans and mortgages to savings and investments. Understanding the Federal Reserve's role. The Federal Reserve, often referred to as the Fed, is the central bank of the United States. Its primary responsibilities include managing inflation, regulating the banking system, and ensuring economic stability. One of the key tools the Fed uses to achieve these goals is the manipulation of interest rates. By raising or lowering the federal funds rate, the Fed can influence borrowing costs, consumer spending, and overall economic activity. The current economic context. As of today, the Fed is expected to cut interest rates by 0.25 percentage points, bringing the federal funds rate down to a range of 4.5% to 4.75%. This decision comes in the wake of a previous rate cut in September, which was a more substantial 0.50 percentage points. The primary reason for these cuts is to counteract slowing economic growth and to keep inflation in check, which has recently dropped to 2.1%, just shy of the Fed's 2% target. Impact on borrowing costs. Mortgages. One of the most immediate effects of a Fed rate cut is on mortgage rates. While the federal funds rate doesn't directly set mortgage rates, it influences them. Lower rates can make home loans cheaper, potentially saving homeowners hundreds or even thousands of dollars over the life of their mortgage. However, the initial impact might be modest, with more significant savings accruing over time as further cuts are implemented. Credit cards. Credit card interest rates are often tied to the prime rate, which moves in tandem with the federal funds rate. A rate cut can lower the interest you pay on outstanding credit card balances, reducing your monthly payments and overall debt burden. This can be particularly beneficial for those carrying high balances. Auto loans. Similar to mortgages and credit cards, auto loan rates are influenced by the Fed's decisions. Lower rates can make financing a new or used car more affordable, potentially boosting auto sales and benefiting consumers looking to purchase a vehicle. Impact on savings and investments. Savings accounts and CDs. While lower interest rates can be good news for borrowers, they are less favorable for savers. Interest rates on savings accounts and certificates of deposit, CDs, tend to decrease following a Fed rate cut, leading to lower returns on your savings. This can be a challenge for those relying on interest income, such as retirees. Stock market. The stock market often reacts positively to rate cuts, as lower borrowing costs can boost corporate profits and economic activity. Investors may see an uptick in stock prices, which can enhance the value of their portfolios. However, market reactions can be unpredictable, and other factors, such as economic data and geopolitical events, also play a significant role. Bonds. Interest rate cuts can have mixed effects on the bond market. While existing bonds with higher interest rates become more valuable, new bonds issued at lower rates offer reduced returns. Investors need to balance their portfolios to manage these changes effectively. Long-term economic implications. The Fed's decision to cut rates is part of a broader strategy to support economic growth and maintain stability. By making borrowing cheaper, the Fed aims to encourage spending and investment, which can help stimulate the economy. However, there are potential downsides to consider. Inflation. While the current inflation rate is near the Fed's target, sustained rate cuts could eventually lead to higher inflation if economic activity picks up too quickly. The Fed must balance the need for growth with the risk of rising prices. Debt levels. Lower interest rates can encourage borrowing, leading to higher levels of consumer and corporate debt. While this can drive short-term growth, it may pose risks if borrowers are unable to manage their debt loads in the future. Global impact. The Fed's decisions also have international implications. Lower US interest rates can affect global capital flows, exchange rates, and economic conditions in other countries. This interconnectedness means that the Fed's actions are closely watched by policymakers and investors worldwide. Conclusion. The Federal Reserve's rate cut decision today is a significant event with wide-ranging implications for your finances. Whether you're a borrower, saver, or investor, Understanding how these changes affect you can help you make informed decisions. While the immediate impact may be modest, the cumulative effect of multiple rate cuts could provide meaningful relief for borrowers and influence economic conditions in the months ahead. As always, it's essential to stay informed and consider your financial goals and risk tolerance when navigating these changes. By doing so, you can better position yourself to take advantage of opportunities and mitigate potential challenges in this evolving economic landscape.